Now, let's spend some time in terms of understanding volatility smile. Conceptually, volatility smile is a kind of a plot of volatility. It's a graph of volatility either against the strike price X, which is the most common stuff, or we are trying to plot the volatility against various other factors which we are going to look at. How the shape of volatility changes as the strike price changes or any other underlying variable changes, how the volatility changes is what is the content that goes into this topic. So we are going to look at why the volatility smile is same for call options as well as put options. We say that it is the same, so we want to find out why it is the same. How does that volatility smile graph look like for a foreign currency option, and how does it look like for an equity option, and why does it look like in that way? What are the alternative ways of characterizing the volatility smile? In general, the volatility smile is the plot of volatility against the strike price, but what are the various other ways that we can use for it? What do we mean by the volatility term structure and volatility surfaces? Some kind of conceptual and definition kind of stuff going into it. And how do I compute the Greek letters, or how do I understand the Greeks using the volatility smiles? What is the role of the Black-Scholes model, or for that matter any other model, in the characterization of the volatility smiles? And how does this volatility smile get affected when a single large jump is anticipated in the asset price? So these are some of the important things that we are going to take up here. First of all, a quick trying to understand what is a volatility smile, and then we'll try to see why is this volatility smile same for call options as well as the put option. So here I am trying to plot the implied volatility of an option. Implied volatility, we have already understood that this is the volatility that we are getting by equating the Black-Scholes model price of the option with the market price. So solving for the volatility as an unknown by equating the Black-Scholes model price with the market price of that option. Now what we are saying is, I'll try to plot the implied volatility of the option with a certain life. So which means it could be a 3-month option or a 6-month option, whatever it is. So I'm trying to plot the implied volatility of the option with a certain life as a function of its strike price. So I'm taking the strike price X on the x-axis and the implied volatility on the y-axis. Now for a very low strike price, what is the implied volatility? Then if the strike price is increased, what is the implied volatility? If the strike price is a little bit more, what is the implied volatility? So a joining of all these things is what we are calling as the volatility smile. Now what this text says is the implied volatility, whether I am taking for a European call option or for a European put option, it is going to be the same. This we can prove even from the Black-Scholes model as such. If they are having the same strike price, same time to maturity, the implied volatility remains to be the same for call option as well as for the put option, which means the volatility smile also remains the same because the strike price is the same, and we know that the implied volatility is the same for call as well as the put, which means the volatility smile also for that same maturity should be the same. So we are really not bothered whether we are working out for the call options or the put options, and this is even based on a put call parity relationship. Right? If I am looking at a put call parity, we simply say the call price minus the put price is nothing but the present value of the stock minus the present value of the strike. The stock price minus the strike price. That should be the difference between the call and the put. So this is purely based on a simple no arbitrage argument. And the reason that it's a very important relationship for us is it does not make any kind of an assumption regarding the probability distribution. It does not say this formula is applicable only when the stock price follows a log normal distribution or a normal distribution. Nothing is required. This is a universally accepted kind of relationship. So that's one of the important reasons the put call parity relationship plays a very essential role in the asset prices. So which also gives us a simple relationship to look at. So which means whether I use the Black-Scholes formula or I go with the market. So the Black-Scholes assumes that the log normal distribution is followed by the stock price. Market may not assume any kind of a relationship between of the stock prices, but still what we are saying is because the put call parity will hold true, these two equations should be the matching one. So when I am doing the put option pricing with Black-Scholes and call option pricing with the Black-Scholes, this relationship should hold true. When I am taking the put option price in the market and call option price in the market, also the relationship should hold true. Now when I am looking at both of them, the difference between the Black-Scholes and the market based put prices should be equal to the difference between the Black-Scholes and the market based call prices, which means that the dollar error should be the same, which also gives us an indication that the volatility should be the same, whether I am going with the put or with the call, whether I am using market or the Black-Scholes, the difference should be the same, which means the volatility will remain to be the same. Once the implied volatility is the same, the graph of the implied volatility against the strike price should remain the same. That's one of the prime reasons we are talking about the volatility smile being the same for calls as well as for the put option. Now, we will look at two major kinds of options for understanding the volatility smiles. One is the foreign currency options, and the other one in the next slide we will be looking at the equity based option. So when I take the foreign currency options, this is the kind of a volatility smile that we really look at. It looks like a proper smile. That's the reason the name comes like a volatility smile. So this is where the implied volatility is the least, which is what we are calling as at the money strike price. Right here, the strike price is much lesser than the stock price. Means these are all in the money. Right? Strike price is much lesser than, so this is where the strike price might be equal to the stock, and this is where the strike is lesser compared to the stock. So the stock price is higher. So for a call, these are ITMs. For a put, these are OTMs, out of money option. Similarly, this side looks like out of the money for the call because strike is more than the stock. So this becomes out of the money for the call and in the money for the put. Now what we are saying is typically when I look at a foreign currency option, the implied volatility graph looks more like this. So it is the lowest at the money option. The moment the stock moves more in the money or out of money, the option moves, we see that the volatility, implied volatility is going to be higher. So if I use this information and try to map it to the distribution of the underlying asset, okay, here at the money the implied volatility is lower. Implied volatility is lower means the option price could be lower. But if you look at going away, in the money or out of money, what is that? I could see the implied volatility is higher. If the implied volatility is higher, the option price or premium is going to be higher. So what I could get is the option premium is higher as the option is going more and more in the money. Similarly, the option premium is higher as the stock is going more and more, as the option is going more and more out of money. So if you are trying to look at the distribution, compare it with the log normal, you will find that it has heavier tails compared to the log normal. So you could see if the log normal distribution is this dotted line, whereas the implied distribution which we are getting through this implied volatility smile model, we are seeing that the peak is slightly narrower compared to log normal, whereas the tails on both the sides are comparatively wider. What does that mean? You are getting for much lower stock prices, right? For much lower stock prices, we are finding that the option price to be much higher, and even for much higher stock prices also, we are seeing that the option premiums are slightly higher. So which is again a clear indication that the probability that the option would be coming in the money will be higher for both the cases. If the stock price has gone down, the volatility is higher compared to that of a normal distribution, which means the chances that the option will be exercised is going higher, which means the frequency there is slightly higher, which is what is represented in a heavier tail on both the sides. So if you try to understand the risk neutral probability distribution for an asset at a future time compared to the volatility smile maturing at that particular time. So you are getting a relatively higher price both for OTM as well as the ITM option. So you could very much link these two diagrams. Here it is saying because for lower ITM and OTMs the volatilities are higher. Volatilities are higher directly is implying that the option premiums are going to be higher on both the sides, because the chances of exercising the option will become more and more as the volatility is increasing. So the volatility is not flat across. Now why are we talking about, now if I go back to the theoretical side of it, why is that kind of a smile coming up in foreign currency option? Why is it not the case that the volatility, implied volatility is constant across? Why is it coming more like this? Right? Now this is where we are talking about a few reasons. If you are really assuming that the asset price is following a log normal distribution, the volatility should be constant. If you are perfectly assuming that the asset price is following a log normal distribution, we see that the volatility of the asset should be constant. But in reality, probably for the foreign currency, you don't see that the volatility constant. It keeps changing with time. The price of the asset should change very gradually, an increase or a decrease. So it can't be a kind of a jumps like this. So whereas in case of foreign currency, we can very well see that even a jump is possible and even the volatility may not be constant over time. Which means I cannot purely link the foreign currency asset price movement with that of a log normal distribution. right? So the extreme outcomes are very much possible in case of foreign currency. Either I can look at a very big drop, or I can look at a very big increase as well, and which means there is a possibility of good number of jumps. I can see a drastic fall, or I can see a drastic increase within no time, and the volatility can keep changing with time, especially with respect to the option maturity. So especially when I am looking at the maturity period is increasing, and I am looking at a non-constant volatility. See, let's say there is a long time period to maturity, and the volatility is not constant. You could clearly see the impact on the stock price, impact on the option price very heavily, because one, the time to maturity is very high. Two, the volatility is fluctuating a lot, which means the impact or the probability that the option gets exercised is much higher. Any time within that time to maturity, the option can get exercised. So generally you will find the higher is the time to maturity, this non-constant volatility, the impact of it is much higher. But when we are looking at from a percentage impact perspective on the implied volatility, that becomes much lesser, because the implied volatility, if it is changing with time, the impact of that is much lesser. So what we could see is as the options maturity is increasing, the impact of the volatility smile becomes much less pronounced. This is a very important aspect, right? Volatility smile very much looked at in case of short term options, whereas when I am looking at more and more long term kind of an options, the impact of the volatility smile may not be that heavily seen. Then if I move on to plot the similar kind of a graph for equity options, we don't see a perfect smile like structure like this. We call this as a volatility skew. We see it more like a downward sloping like this. As the strike price is increasing, we see that the implied volatility is decreasing, which could clearly make us understand. If I am looking at the low strike price, which means stock price is greater than the strike price, which is in the money option for a call or out of the money option for a put. Especially for low strike price, the volatility that is coming out is much higher compared to the volatility for a high strike price option. That's some kind of thing which we observe in case of equity option, which means is also if I bring the analogy here, because at the lower strike prices the implied volatility is higher, the pricing is going to be higher at much lower strike prices, which means the chances of option getting exercised become more and more, which is also an indication that the prices are going to be higher, which means the log normal distribution is going to compared to the log normal distribution, the asset prices are going to follow a heavier tail on the left, whereas on the right, which is for higher strike prices, we are seeing that the implied volatility is going down, which is also an indication that when I look at the distribution of the implied with respect to the log normal, the tail will not be that heavier in case of the equity option. Implied distribution has a heavier left tail and a less heavy right tail compared to the normal. Whereas in case of foreign exchange options, we have clearly seen that the tail is heavier on both the sides. And why does this come up in case of equity? There's an interesting argument for it. See, when you look at the company's equity falling, right? If the company's equity is falling, the debt or the debt to equity ratio is going to increase. then the equity becomes more and more risky. And if the equity is becoming more and more risky, the volatility of the company, the results, the volatility is increasing drastically. And as the stock price is increasing, I could see that the volatility keeps decreasing. That's one of the prime reasons we could clearly see that this kind of a shape comes with respect to the equity option. When the stock price is decreasing, we see that the leverage increases, so the volatility increases, and vice versa. Now, alternative ways of characterizing the volatility smile. So till now, whatever is the shape of the volatility smile that we have plotted, we have taken the strike price on the x-axis and the implied volatility on the y-axis. What we are also saying is the volatility smile depends purely on the current price of the asset, right? Because that is where we are using one Black-Scholes model or some other model to derive the implied volatility. So depending on the stock price, I will make out whether it is in the money, out of the money, at the money kind of an option. And volatility smile shape is coming purely because of that. Now if the exchange rate is increasing, I could see that the volatility smile is moving to the right. If the exchange rate is decreasing, it is moving to the left. So the same smile, probably it is like this at the current. If the exchange rate is increased, probably it is moving slightly to the right. If the exchange rate is decreased, probably the same thing is moving slightly to the left. So to make it more and more stable, I can look at plotting the same, not just with volatility, I not just with strike price. I can look at it as the ratio of the strike price to the spot price. Right? Instead of taking a direct stock price or strike price, I can very well look at plotting the implied volatility against the ratio of the strike price to the stock price, which makes the graph more and more stable. And in some cases, instead of the spot price, people also look at the forward price. The ratio of strike price to forward price also can be used for plotting. And in some cases, people also make plotting of this relationship with respect to the delta of the option. But whatever it is, the intention of looking at the volatility smile is with respect to some of the essential parameters of the underlying asset, how does the implied volatility change or gets affected? That is what is being considered more as a part of the understanding of the volatility smile. Then a few more important concepts. What is volatility term structure? Where we are trying to look at the time to maturity. Right? With respect to time to maturity, if I am trying to understand the volatility implied volatility or the volatility smile with respect to the time to maturity, then we are talking of a term structure, which in general what we could see is we could see a volatility term structure. So if I am taking the time to maturity here and the implied volatility here, either I could get a graph like that or probably I could get a graph like this. Now where do I find the difference? Now this is where it says the short term volatility, if it is very low, right? If the short term volatility is low, as the time passes we see that the volatility is going to increase. But if the short term volatility is much higher, we see that as the time passes the volatility keeps going down. So it's a kind of mean reverting kind of a behavior that we exhibit, that we understand with respect to this implied volatility. So expectation that if it is already low now, people expect that it is going to go high in the future. If it's already high, people expect that it is going to go low in future. So in general, the shape of the volatility term structure we expect in this kind of a manner. Then, what is the volatility surface? Now, this is where I am bringing in three-dimensional perspective. I look at the term structure and I combine the volatility smile with the term structure. So, which means there are three things here: strike price, time to maturity, implied volatility. If I am plotting a graph with three, it's a kind of a three-dimensional structure that is going to come out, and that is what I am calling as the volatility surface. And the shape of the volatility smile now, it depends one on the option maturity as well as any of the implied volatility looks on the strike price. So along with the time to maturity, if I start looking at the shape of the volatility smile keeps changing. Moving on. The Greek letters, to some extent, it complicates the calculation if I am bringing in the volatility smile, because for calculating delta, for calculating gamma, we assume that all other parameters are kept constant. But volatility smile is saying that the volatility keeps changing with the stock price. So the volatility does not remain constant, which means the computation of the Greeks become very, very complicated. Because if the underlying asset is changing, I should not want any other parameter change. That is what my delta is meaning. So but because we know that the implied volatility is changing, what we get in reality is much higher than what the Black-Scholes-Merton model assumes. Because with respect to the Black-Scholes, we are saying sigma is constant. Now, if the sigma is constant, I am getting some Black-Scholes-Merton price per call option. But now, if the option volatility is changing, generally when I move from at the money to in the money or out of the money kind of stuff, I am seeing that the volatility is increasing. If the volatility is increasing, the price has to increase. And if the price has to increase, the percentage change in price is much higher, which is what is telling that the delta is higher than what is predicted by my simple Black-Scholes-Merton assumption. So the actual Greek, what my Black-Scholes model has predicted is having a lesser value compared to what the reality comes out because of the change in the implied volatility of the underlying. So banks try to ensure that their exposure to the most commonly observed changes is very, very reasonably small. Right? Then, so do I really understand then the Black-Scholes-Merton model plays an important role in understanding volatility smile? For that, if I traditionally look at the Black-Scholes model, it's a sophisticated interpolation tool for the option pricing with the market prices of other actively traded options. Which means if I am switching to any other model, I am sure that the volatility surface, volatility shape, everything would change, because at the end I am computing the implied volatility using the Black-Scholes model itself. But the market prices, they do not change. Delta do not change. So model, yes, it has the effect on pricing of the derivatives when similar derivatives do not trade actively in the market. Otherwise, if they are traded actively in the market, I don't see switching to any other model will have any kind of a significant impact. The model plays a very important role only when the active trading of the derivatives does not happen. Right, so basically, even if I switch a model, if I have to equate it to the market price, then all the adjustments do happen. So, which means as long as there is active trading, the role of a model becomes more and more negligible. And then another question, in case there is a single large jump which actually comes with some kind of an important news announcement, so which can either increase the stock price or decrease the stock price drastically. In that case, we always talk about two probability distributions like this. We always talk about two probability distributions like this. For a good news, we talk about one probability distribution. For a bad news, we talk about another. And the true probability distribution will become a bimodal kind of a distribution depending on. So it is no more a log normal distribution. This becomes a bimodal kind of a distribution depending on how the reaction happens to the news, whether it goes more in terms of a good or in terms of a bad. So even if you look at the volatility in both the cases, it is going to be higher when there is a single large jump that is anticipated. So this is what we wanted to look at as a part of this session. Why the volatility smile is same for calls as well as puts. We wanted to we spent some time in terms of understanding the foreign currency options, the equity options, the different alternative ways of characterizing the volatility smile, not just with the strike price but the ratio of strike price to the stock price. We also talked about why not use a forward price instead of the stock price, or why not use the delta. Then we are talking about the definitions. We have talked about the definitions of the volatility term structure and volatility surface. Then we said why the computation of the Greeks become difficult when there is a volatility smile, and answered a couple of important questions like, does the model play an important role in terms of the understanding volatility smile, and what if a single large jump comes as a part of the pricing of the option, right?